Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. This is another one of my continuing subscriber request series videos that I'm going to do today. I was asked recently by a subscriber to take a look at Alexion Pharmaceuticals, and I want to make a couple of comments about subscriber requests. First of all, I obviously don't have time to do every request that comes in, but I do try to do the ones that I think either have an educational value to them, where I can share some investing wisdom, if you will, with the subscribers that are tuning in, or that I think are interesting long-term investments. But in this particular case, I think I also might point out that I've been primarily focused on investing in dividend stocks, dividend growth stocks. Now, when I invest in dividend stocks, I still look for capital appreciation as part of the overall strategy, but I'm primarily focused on the level of income I'm receiving and whether that income is growing over time or not. That's one of the real allures, I believe, of investing for dividends. However, with that said, I still like a growth stock, and most of my career, especially when I was younger, I actually looked for growth stocks, kind of the Peter Lynch, 10-bagger concept, and I'm going to show you one today with Alexion Pharmaceuticals. But one reason I really chose to go ahead and do this particular video was because I believe it gave me an opportunity to also simultaneously show you how I go about the process for myself of researching stocks. And of course, you can either follow my lead or do your own processes. But I thought it would be interesting to share that because this was not a company that I've been following because, as I said, I was looking primarily for dividend stocks more recently. But when I did look at it after it was requested, I did find it a very, very interesting company, and I think it offers some real great teaching lessons, not only about investing in general, but also for subscribers to FastGraphs, who I think there's some things here about learning how to utilize the tool most effectively can also be learned by looking at Alexion. So let's go ahead and get started, and let's look at the company. The way I like to approach researching a company that I'm not familiar with is that I always start out with an all graph. I try to go back as far as I can and look at all the company's history. And what's very interesting about this company, I do want you to notice, I'm going to take price off the graph here, and I'm going to take this normal PE so that you see what's going on. This line on a fast graph to me is critically important because this is the rate of change of earnings growth from one year to the next. And but just by running your eye across that line, or your mouse, following your mouse across this line, you can see what kind of growth has been going on and what's been happening. Now, I want you to notice we're scoring this at NMF, which stands for no meaningful figure, because you've got losses from 01, 02, 03, 04, 05, 6, and 7. It wasn't until 2008 where the company actually launched on one of their more important blockbuster drugs where they actually started making money. Now, from that point forward, they grew very rapidly. But here, we're using a default PE ratio of 15, I want you to notice. So this orange line is a PE ratio of 15. Now, the reason that's important is when I put monthly closing prices on the graph, I want you to notice not much really happened over these years as far as the price in, 6, 7, 8 years here went from, $13 down to $9. It wasn't a great investment during this time, but keep in mind the company wasn't making any money. And from one year to the next, their earnings fell 126% from a negative 34 cents to a negative 78 cents. So this is quite common for new young companies. Now, by looking at this graph, I can also point here and tell you that it went public early 2001. And again, because it's a biotechnology company, so a lot of people refer to this particular one as a biopharmaceutical. They have to get drugs approved and so on. So they raise money anyway. Bottom line is nothing really happened, but then they started growing. So if I drop this graph down to a 14-year graph, now what I'm doing here is I'm trying to create some data. I'm trying to get some data on the graph that I can analyze. Now, all of a sudden, we have the growth phase of Alexion. And I want you to notice the earnings growth rate from 2009, now I can go back one more year. I want you to see this. You're using the tool to think. I still get a no meaningful figure because I'm going from a negative number to a positive. So what I want to do is I want to have data that I can run the mathematics on and actually do some calculations with. So here I'm looking at from 2009, where the company earned 44 cents, up through 2019, where they earned 10.53, and then including some estimates where the estimates are for $13.14 by 2022, we have a growth rate now of 35%. And now we're using the Peter Lynch P equals growth rate formula, which means I'm drawing the orange line at a PE of, in this case, 34.09. So, it's on the pop-up, it says 34.1, obviously rounding. And you could see the price followed that high multiple because this was a very high growth phase. And then we had a couple of down years on the stock where earnings growth went to -4% and -7. Once again, running your eyes across this column is so critically important to getting a sense of what kind of growth, how consistent the growth is. Of course, you can also see that in the graph. Now, I also want you to notice there's no white line and there's no light green shaded area because this is purely a growth stock. There is no dividend income. You can see the dividends are obviously zero. So this is purely about capital appreciation. Now, during this growth phase, if I calculated performance from here to here, you can see that if I invested $10,000, just metaphorically speaking, if you will, I would have turned that into over $107,000 over this, about 6-year time frame here, averaging 49.5% compounded growth rate or annualized, but it was all functionally related to that. Now, what's interesting is, though, I then hit a spell, and this is what's really important about investing in growth stocks, and one of the real lessons I want to share here, and that is that when you're investing in growth, you've got no dividend income, you're getting no return of your original investment through dividend income. So you're really exposing all your capital to the risk of this company or the company that you choose growing at very high rates. And of course, the bigger the company gets, the harder for it is to grow at high rates. Well, the company went through a stumbling block here where they had 2 years of negative growth. Not bad. They still were very, very profitable. These were still the second and third most profitable years in the company's history, which is a relatively short history. But notice what happened to the stock price. So now if I measure what happened to the stock price, we had this little catalyst of negative earnings growth, and the stock price then fell from $194.90 down to $108.47, and it would have turned $10,000 into $5,565, or virtually, cut your investment in half had you bought the stock, put $10,000 in on this day. Again, this is just running calculations for you, and that's almost a 10% annualized, a 9.9% annualized compound loss, total annualized loss. So bottom line is that you're very vulnerable. Now, I also want to make some other points about fast graphs. If I go back to the all graph, I've switched to this 15 PE because, as it says here, it's a default PE, and that's the normal PE of the market. So this makes the company look extremely overvalued when you look at it from this perspective. When I drop it to that 14-year period where we're, basically have a time where we have good data that we can actually, create growth rates and so on, like I have here. Now I've got a PE ratio of 35. The 15 PE ratio really didn't apply to this company once it started growing, and that's the real key I want to point out. But now, having said that, now we have a situation where the earnings growth rate has changed. The company has had 2 years of down earnings. And of course, that created a lot of negativity in the stock. And even though the company has started growing again and even settled some issues, they had a patent dispute with Amgen. They made some acquisitions. A lot of things have happened here with the company. They got an accusation of fraud from the SEC that they were paying off some foreign people to produce their big blockbuster drug or to give them preferential treatment for their drug. So when you get negative sentiment around a company, especially a very high growth stock, that negative sentiment can really do a lot of damage to your portfolio's performance over time. But again, what I want you to notice here is now this stock went from being a very pricey stock because it was, being valued based on this very high level of growth. Then the growth slowed down dramatically. And by the way, I can even use my scroll bar here and go back in time and kind of calculate that growth. And I do want you to notice that the growth rate was still very, very high during this period. But again, we started to have a drop. But notice how undervalued the stock now has become. And that's really the point. But here's the insidious part about this. Once sentiment gets negative, it can stay negative for a relatively long period of time. And the fundamentals all of a sudden get out of date. Now, JP Morgan did a study, I think I shared this with you the last time we talked, where, sentiment tends to rule over short periods of time. But for periods of time of 7 years or more, fundamentals rule. Now, this is kind of in line with that, but also the exception in a way, because we've had a period of 1, 2, 3, 4, going on 5 years, going into our 6th year, where what we've had now is we've had significant undervaluation. In theory, and I think this is very, very important, in theory, I would say this stock has been very attractive, since about February of 2016. but it has also stayed a very poor performer over this time frame. I can run these calculations, but it's still generating losses over this time frame. But what is happening to the company at this point, we're starting to get some really high growth. We've got earnings growth of 27% for 2017, 35% for 2018, 33% for 2019, and then all of a sudden we're expected to have a low growth rate again. So growth and consistency of growth is very, very important when you're dealing with growth stocks. But having said all that, if I go look at the forecasting calculators right now, this is really important. I learned from the past. I get to evaluate how the business has performed during the past, and I can again see how consistent it's been, what the growth rates have been, and so on. But now we've got a $25 billion, almost $26 billion company here, almost $24 billion company. It's going to be a lot harder for them to grow. Now, they have made some acquisitions. They've got a pipeline, which I'll show you here in a moment. And there are quite a few analysts following this company. There are 22 analysts, and it drops off to 20 analysts by 2022 that are looking for rather modest growth this year. And there are some reasons for that. They just recently settled a patent dispute with Amgen and so on. But then they're looking for 11%, 9% growth in future years. So that comes out to about almost an 8% growth rate. But the point is, the stock is trading at a blended PE of 10.14. That's extremely low. That gives an earnings yield, a current earnings yield of 9.86. But because of this growth, it has a much higher earnings yield. Now, another thing I like to check when I'm doing this is what is the longer term trend line growth rate. So if I go to the 3 to 5 year growth rate, I discover that there are 5 analysts who are forecasting 10.3% growth for Alexion. Now, again, I'm just starting to research this company. I had not followed it before. I didn't know a lot about it. So I actually go through some other processes here. One thing, when I'm looking at future and earnings estimates, I'll go into Yahoo estimates directly from Fastgraphs, I might point out, and I'll go look at what their next 5 year number looks. Now, these guys get their estimates from Reuters. At Fastgraphs, we're getting them, they're being collected by FactSet, and other sites will have estimates coming from Standard & Poor's. They're really pulling a similar group of analysts, but if I look up here, their universe is 21 to 25 or 25-ish analysts. We had 22 analysts on what we have on Fastgraphs, but the point is, these guys are saying 12.6%. Now, I know these forecasting calculators are wrong. I want them to be reasonably right. So I've got a range here between 10 and 12 or 13%. So I'll stick with my conservative 10%, and then I'll run calculations. Now, when I'm using this calculation, I tend to go out here to the later years and try to say, if I could get an average growth of 10%, I could make 20% a year annualized on this stock if the PE ratio only traded at 15, which is a kind of a market neutral PE ratio. If I look at, the current PE ratio, which is again just below 10, 9, so I can point here to 10, 10.5, or even here the 9.5, and I still have double-digit rates of return, 8.6% at a PE ratio in the 9s. And if I go to this 10.5 number here, I've got a potential annualized rate of return of 11.7. But those are just rough calculations. The point is, I've got good numbers, expectations on this company, and it could grow at double-digit rates, and I can buy it at a very, very low valuation. But I do want to make a point. I'm not thinking about it at the 35% growth rate it's had historically. I can learn from the past, but I can only invest in the future. Now, the other part of my process here, I'm going to go through this rather quickly now so this video doesn't get too long. I'm really going over the process here more than I even am Alexion. So what I'll do is I'll go through all these other metrics. Now, even for non-dividend paying stocks, I want to see what operating cash flows look like. So I'll actually look at all of these metrics. I do want to be clear. I'm not going to bore you with that here in this video, but I get different perspectives when I run these different metrics here. Operating cash flow is a little more spotty, if you will, than operating earnings were, but they still have generated positive cash flows all the years. There's been very high cash flow growth in cash flow. A lot of it, I'm guessing, has to do with expectations of both a pipeline as well as some acquisitions the company has recently made and completed. So I've got a real high expectation of cash flow. But I'll go through EBITDA, I'll go through free cash flow, which is always important because you want to see what's really left over. What I'll also do is I'll go into fund graphs, which are financial underlying numbers, which Fastgraphs has, and I'll start looking at things like the current ratio and the quick ratio. This company was 17% long-term debt to capital that I kind of briefly pointed out here a minute ago. It's got a very strong quick ratio and current ratio. There's no liquidity issues with this company at all. I might go into the percentage graph and I'll look at things like gross and net profit margins. Now, keep in mind, obviously, when they were losing money during all these years, even though they had some gross margin in some business, they were, really doing nothing. So what I'll do is I'll shorten this to, what's it look like recently, and all of a sudden their net margins are starting to increase. That's a positive sign. If I look at it, over the last 8 or 10 quarters or so, I'm starting to see some good margin improvement, but there's still a long ways to go. And keep in mind, their biggest blockbuster drug is getting close to coming off patent. Now, I'll go into either the per share graph or the millions graph. I do want to go into the millions graph first, because one thing I want you to notice, that the valuation of this stock has been very, very high for all these years, these 2014, 2015, 16, et cetera. And the company was raising capital. They were actually issuing shares. They weren't buying back shares. But I think what's important about this is they were doing it when the price of their stock was actually very, very high. But I also want you to notice that the company has been since they started making money, again, not during these years when they were losing money. So I'll shorten this just for the last 10 years. They've been growing revenues over the last decade or so, and this includes no estimate data, by the way, at almost 30% a year, 29% a year. So their revenue stream, this is gross revenues, has been very, very good. They're at $4.9 billion through last year, and that's up from $383 million in 2009. But I'll go through a lot of other metrics here. I just want to point out the process that I'm going through. The other thing that I'll always do is I'll go directly into the company's corporate website from FastGraphs. And this is where I'll start to really dig in and learn about the company. I'll go into investors and try to see if there's, any presentations that I can look at. I'll try to get into looking a little more about the company. I'll try to discover their pipeline, for example. So after I've looked at their presentation, their investor services department, I go back into their main site here, and I'm looking for things like here. I'm going to look at their medicines, and see what kind of medicines they have. I'm trying to learn about the company. So they've got the conditions that they treat. I can dig deeper into that. I'm not going to bore you in terms of this video. I'll go into their research, and this is with a pharmaceutical company. This is where things start to get real interesting, because what I'm looking for is I want to see what their pipeline looks like. So here I'll go down to their pipeline. I'll click on their pipeline, and knowing what I do know about pharmaceuticals, and that's not a whole lot, I know that phase 3 means that the drugs that have gone all the way through preclinical phase 1 and 2, there's the highest percentage of drug approvals are going to come from phase 3. And this company has a lot of drugs for some very interesting, this company treats rare diseases, by the way. So, they've got all these drugs in phase 3. They've also got several in completing phase 2, and then another group in preclinical. Now, I'll spend some time trying to learn more about that and trying to really understand the company as best as I possibly can. What I really want you to get out of this is really a process. Other things I'll do is I'll go into research. I have to subscribe to Morningstar as well. I'll go into Morningstar. They actually have a full analyst report on here. I'll, get their opinions. I like to do my own valuation numbers, but I'll look at their numbers. The last close of 108, they're saying fair value is 155. That's reasonably consistent with what I'm seeing on FastGraph, what I was showing you earlier. I'll go through any type of research here. I also subscribe to Zacks Equity Research. I'll go in and look and see what Zacks has to say about the company. But I'm really going to spend most of my time in the company itself, trying to learn about their products, learn what they do, how they do it. Now, I'll go I can go to websites like Seeking Alpha, Wall Street Journal, Yahoo Finance, and look for any information. I mentioned they just had a $21 million settlement where the SEC accused them of paying off foreign officials so that they could get preferential treatment on their drug Solarius. So that's a drop in a bucket for a $25 billion company. They did not admit or deny that they had. They just went ahead and paid the claim, and that's probably a good idea. So, but that's something I'd think about. But anyway, the bottom line is I go through this process, but ultimately, once I've kind of got my own opinion and decision about the company, I'm going to go in here and run my calculations on what I think this company is capable of providing me as an investor. What rate of return? And I've got to have an earnings yield of at least 6.5%. Why bother if it's not that much? I'm trying to get as strong a sense of whether I believe and trust this company. I'll look at things like the company's analyst scorecard. It's a pharmaceutical company in 2015 and 16. Remember, those were the the bad, those were the years when they had some losses after such great growth. The analysts missed their growth rate quite a bit, but their overall analyst scorecard is really quite good. Again, it's a short history here, but they did miss, 18% of the time with a 10% margin of error on the 1 year and a 20% on the 2 year. So I'm just going through this whole process here and trying to get comfortable with the business that I'm looking at. Looking at things, the level of debt. This company is not filed for a credit rating, so they don't have a credit rating, but they have a very modest level of debt. They've got very strong cash flows. They've got very high current ratio and quick ratios. So, I think the quality of this company is a going concern. It really comes down to, is this company going to get the drug approvals, and are those drug approvals going to be profitable for them going forward? But anyway, this is a company that I would suggest learning more about. I think it's very inexpensive. I think its long-term growth rate is probably going to be double digit, or at least likely to be double digits, like the analysts on Reuters as well as FactSet and even companies like Seeking Alpha are suggesting. So, the bottom line is, when I look at this stock, if I was investing for growth, I think this is one that can be very attractive. By the way, it's very, very hard to find a good growth stock today. This is one that does have double-digit growth. It's not growing at 35 and 40% a year anymore like it was when it was a smaller company, but I think you can still do very, very well. But keep in mind, growth stocks, because there is no dividend, are always going to be riskier than dividend-paying stocks. But, the risk and reward ratio is also much higher because of the compounding effect of higher growth can generate much stronger future cash flows. And inevitably, the market will price that for you. So anyway, I hope you enjoyed this video. If you like it, please ring the bell. Please give me a like and subscribe to our YouTube channel here. We've got a lot more like this coming. This has been one of our subscriber request series. This is a company that I didn't know a lot about going in, and I'm kind of learning with you, and I hope you really focus more on what I did here in this video about the process more than the actual analysis. The process is what's important. Anyway, thanks for watching.